Welcome to our review session for exam number 5. I have the practice set open in CNow, and that's what you're seeing on your screen right now. So the practice set has an extra exercise. It was an accidental inclusion. So that number 2, brief exercise 12.01 algorithmic, is actually the same as exercise number 1, except maybe with different numbers in there. And so we'll be skipping over that one as we get started. And keep in mind, to find these exercises in CNow, you need to go to the link that says assignments I can practice now, or to all assignments. It doesn't show up under the assignments you can take now because it's not graded. Certainly the expectation is it helps you with exam number 5, but it does not count directly towards your grade. And so we have plenty of time today. We should be able to get through all of these exercises on the video. We're going to go through them in order from 1 through 14. So if there are only a few that you need help with, feel free to certainly, fast forward through the video or do whatever you need to do. We'll get started for, we do have someone here live, and so if the person who's here live has a question, then you may hear her voice on the video asking a question, or you may hear me refer to something in the chat. Looking at our first exercise, again, you can see that the first few exercises are from chapter 12, then chapter 13, and finally chapter 14. So in chapter 12, we were looking at stockholders' equity. We talked about dividend policy being set by the board of directors, and that dividends might be paid on both preferred and common stock. If any dividends are declared, the preferred stockholders, if there are any, need to be paid first. Dividends are paid only on outstanding shares. So if you have information about the number of shares they're authorized to sell, or number of shares that they are issued, and maybe they have some treasury stock, those numbers are really not relevant to calculating dividends. Dividends are paid only on outstanding shares. Excuse me. Exercise 1 then says 0 Calories Company has 20,000 shares of cumulative preferred 1% stock with a $50 par value and 200,000 shares of $10 par common stock. So we can assume that those are the number of shares outstanding, even though it doesn't use that term. The following amounts were distributed as dividends. Determine the dividends per share for preferred and common stock for each year. And if an answer is 0, enter 0. Round all answers to 2 decimal places. Important to point out that the preferred stock is cumulative. So in a given year, if they do not declare sufficient dividends to cover all of those, the dividend for the for the preferred stock, that would carry over as dividends in arrears for the next year. So the first thing I want to do is calculate what is the dividend on that preferred stock. So they have 20,000 shares, and they're paying a dividend of 1% of the par value. So 1% of $50 would be 50 cents per share. And if we're paying that on 20,000 shares of preferred stock, that means that we would owe, and I'm using my air quotes, we would owe $10,000 to the preferred stockholders. The reason I'm saying air quotes is because there is no legal liability to ever declare and pay dividends. So in a given year, like we can see in the second year here, they didn't declare at least $10,000 worth of dividends, and that's fine. It's okay to pay only $8,000, but because these shares are cumulative, that additional $2,000 is going to carry over to the following year for as dividends in arrears, and would be paid in that following year. The other thing I want to point out is that we're asked for the dividends per share. So we know we need to take the total dollar amount that's paid and divide by the number of shares. So let's get started with the first year in 2021, I'll call that. We already figured that the dividend per share for preferred stock would be 50 cents. That's their full dividend, 1% of the par value. And the total dividend then that went to the preferred stockholders would be $10,000. If $30,000 in dividends are declared and $10,000 go to the preferred stockholders, that leaves $20,000 for the common stockholders. And so the $20,000 that's left for the common stockholders, remember they're the residual equity, they get what's left. So the $20,000 in dividends for the common stockholders would be shared equally among the 200,000 shares that are outstanding. And so that would be just 10 cents per share for the common stock. Now in 2022, they didn't declare the full 10,000 for the preferred stockholders. And so the 8,000 would be shared among the existing preferred stockholders, $8,000 divided by 20,000 shares. That would be 40 cents per share. And the other 10 cents is going to carry over to the following year. So skipping ahead, in 2023, the preferred stockholders are going to get the 10 cents that carried over from the previous year, plus the 50 cents for that year. And so in 2023, those stockholders would receive 60 cents in dividends. Now back to 2022 for the common stockholders. Remember, the preferred stockholders didn't get all of their dividend, which means the common stockholders get nothing in 2022. But now let's look ahead to 2023. And we know that the preferred stock had $2,000 dividends in arrears that carried over, plus they would get the $10,000 for that year. So they'd get a total of $12,000 or 60 cents per share. But because $110,000 in dividends were declared and only $12,000 of that went to fully satisfy the preferred stockholders, that leaves $98,000 for the common stockholders. 98,000 divided by 200,000 shares is 49 cents per share. And so you can see that, you know, in a slow year, in a year that there wasn't as much declared in dividends, maybe the company didn't make as much money or didn't have a positive cash flow, the preferred stockholders are still pretty much held in full or satisfied in full. But in that last year, when the company declared a lot of dividends, that really helps out the common shareholders. The preferred stock has a cap on their earnings. You know, they have that preset dividend rate, and their dividends are never going to exceed that. As I said, I'm skipping that second exercise because that was a mistake on my part, setting up the exercises. And once somebody accesses it, I don't have the ability to change it. So moving on then, we're still in chapter 12. We're now looking at issuing stock. And so we looked at several exercises in the chapter for how do we issue stock that has a par value? How do we record that? How do we record when we issue stock for something other than cash? And this exercise says, on January 22nd, Zentric Corporation issued for cash 180,000 shares of no par common stock at $12. So let's do that one first. They issued stock for cash, so we know we're going to increase our cash, but also increase our common stock account. Now, this stock had no par value, and so all of that value is going to go into the common stock account. When we issue stock that has a par value, that par value goes into the common stock, and anything above that goes into the additional paid-in capital or paid-in capital in excess of par. So they sold 180,000 shares at $12 per share. That is $2,160,000. It's going to be added to our cash and added to the common stock account. Moving ahead, then on Valentine's Day, Zentric issued at par 50,000 shares of preferred 2% stock. So that 2% represents the dividend amount. When dividends are declared, they will get 2% of the par value. And the par value on these shares is $50, and they were issued at par. So $50 times 50,000 shares is $2.5 million. Oops. Those were issued for cash, so we're going to increase our cash. And since they were issued at par, that full amount is going to go into the preferred stock account. Oops, got an extra zero on there. And so if they were issued for more than par, again, just like the common stock, we'll see this in the next line. If they're issued for more than par, anything above that par value is going to go into the additional paid-in capital account. And that's what happened on August 30th. We issued an additional 20,000 shares of preferred stock. Remember that concept of authorization. We need to have authorization to issue those. We have to have that available to do. And so on August 30th, we issued that additional 20,000 shares at $54. So our cash is going to go up by $54 for each of those 20,000 shares. That's $1,080,000. And as I was explaining, the par value is going to go into the preferred stock, and the extra $4 above par is going to go into the paid-in capital in excess of par. So $50 in the par value times 20,000 shares is $1 million worth of par value, and the extra $4 per share, $80,000 total, goes into the additional paid-in capital account. Okay, and I'll keep going if there aren't any questions. So we also talked about in this chapter that there are 3 important dates when it comes to dividends. The first important date is the declaration date. So this is the day the board of directors declares formally, yes, we're going to pay a dividend, and here's how much we're going to pay. Then shortly thereafter, within a few weeks, we would see a record date, which determines which owners are going to receive those dividends. And then a few weeks later after that, we have the payment date when we actually are going to issue the checks. And so on the date that we declare the dividend, it becomes a legal liability of the company. We need to report the cost of those dividends, which eventually will be removed from our retained earnings when we close that account. And we need to report on our balance sheet that we owe those cash dividends. On the record date, which in this exercise is November 7th, there's no accounting entry needed, but it is an important date for us because it does determine who is going to receive those dividends. And finally, as we move ahead to the payment date, we're going to reverse that liability because we will no longer owe that because we're paying it. And of course, we use cash to do that. Now, in this exercise, they've already provided for us the dollar amount of the dividend. They could have given us a dividend per share, and we would need to multiply that by the number of outstanding shares to determine the total value or total cost of that dividend. And so those are the 3 important dates, only 2 of which require an accounting entry. Another concept that we talked about in chapter 12 is the idea of treasury stock when a company repurchases its own stock from the open market. We talked about a number of reasons companies might do that. And we said that for our purposes, we are always going to use the cost method of recording treasury stock, which means every transaction within that treasury stock account is reported at the original cost, how much we paid to get that stock back from the open market. On May 27th, Hydro Clothing Incorporated reacquired 60,000 shares of its common stock at $8 per share. So at that time, it becomes treasury stock And again, we report it at cost, at that $8 that we paid for it. So to reacquire it, it means we used cash to pay for it. 60,000 shares at $8 per share is a total of $480,000. Now, treasury stock does have a normal debit balance, unlike our typical equity accounts, and that treasury stock then offsets or reduces our total equity balance. And again, we used cash to buy that back. On August 3rd, Hydro Clothing sold 42,000 of those reacquired shares at $12 per share. So at the time that they sell them, of course, that's going to increase our cash. 42,000 shares at $12 per share is $504,000. It's kind of like that we made money when we sold these shares, but of course we can't increase our income on our income statement by dealing in our own stock. So that is not an income statement transaction. It is a balance sheet transaction. So our cash goes up. Our treasury stock is going to go down because we have sold some of it, but this is where that cost principle comes in. We're going to report in that treasury stock account, every transaction is going to be reported at $8 because that's what we originally paid for those shares when we bought them back in May. So 42,000 shares at $8. We're going to remove $336,000 worth of that treasury stock. But we can see we're not done here because this transaction does not balance. Our debits and credits are not equal. We need an extra $168,000 on the credit side to make this balance. That $168,000 is the extra $4. So we bought these shares for $8 and we sold them for $12. The extra $4, if we reported this on our income statement, it would look like a gain for us. But because this is a treasury stock transaction, we are simply going to record it on the balance sheet as an increase to our equity. And so this is an additional paid-in capital account or contributed capital account related to the treasury stock. And now we move ahead to November 14th, and they're going to sell the remaining shares. So how many shares did they have left? They first had 60,000, but they have already sold 42,000 of those. So we have 18,000 shares left. And we sold those for $6 per share. That means when we sold them, we received a total of $108,000. That's $6 per share times the 18 shares. We need to remove the remaining shares from our treasury stock account, again, because we're using the cost principle. The treasury stock transaction is going to be reported at the original cost of $8 per share, 18,000 shares at $8 per share. What's left in that treasury stock account was $144,000, and now we're getting rid of the rest of that. If you wanted, you could check yourself by adding this plus this. The credits to that account will equal the debit to that account. We know that the treasury stock account is now at 0. And just like we said for the August 3rd transaction, we can't be done here because our debits and credits are not equal. We need an additional debit of $36,000 to make this transaction balance. And this is kind of like we lost money on these shares. We bought them for $8, we sold them for $6. That's going to be a reduction in our contributed capital. Since we've already set aside this paid-in capital here, we can use up some of that to make this transaction balance. We didn't talk about this in class, but if you were looking at this and we didn't have that paid-in capital already set aside here, we would actually have to reduce our retained earnings for that. So just to give you a little bit more information about what that would look like. Since we have that amount, we can use up some or up to all of that. but we could never go negative. That is, we couldn't have a debit balance in that paid in capital account. Okay, so that's the end of our review exercises from chapter 12. I'll assume everybody's good. Nobody's asking me a question. So we'll move on then to chapter 13, which was on cash flow statements. So we're starting out here in this exercise with the operating activity section, which is the first and the most involved and the longest of our cash flow statement sections. We have operating, investing, and financing activities. For this class, we are using only the indirect method, which means as it relates to the operating activities, we're going to start with our net income or net loss, and then we'll have some adjustments. Remember, in Brightspace, in the reference materials folder for chapter 13, there's a whole page of step-by-step instructions for how to calculate these operating cash flows. It explains what the two different sources of adjustments might be and how to record any of those adjustments. So we are asked to prepare the operating activity section. We're going to start with the net income or net loss. So that is provided to us right here. Whoops, this top line. If it was a net loss, we want to make sure, of course, that we show that as a negative. We then move on to the adjustments. We know that the adjustments can come either from the income statement or from the balance sheet, probably both. The first adjustments are going to come from the income statement. And the first thing we're looking for is any non-cash expenses that reduced our net income but did not affect our cash. So we have three different non-cash expenses we're looking for. Depreciation is one. The other two, less common, are depletion and amortization. So depletion is related to natural resources and amortization related to intangibles. We're given that there was depreciation expense recorded of $81,750. Again, that reduced our net income but did not affect our cash, so we need to add that back. The other type of adjustment from the income statement would be any gains or losses from investing and financing activities. So these properly belong on the income statement, but they are not operating activities, and so we need to remove those in the operating activity section. So you can see in this next line that there was a loss on disposal of equipment. That loss reduced our net income, but again, was not related to operating activity. So since we've subtracted it out of our net income, we need to add it back. If it was a gain, we would need to subtract that. So those are the two different types of adjustments we're looking for from the income statement, and then we move on to the balance sheet, and we're going to look at each one of the current assets and liabilities, also known as the operating accounts. And apparently for this simple exercise, we have just one current asset and one current liability. So again, there are instructions in the reference materials folder for chapter 13 that tell you exactly what to do with an increase or decrease in a current asset and an increase or decrease in a current liability. So we'll start with the increase in accounts receivable. You can look at that page of guidance if that's helpful for you. If you're not really sure, we don't just want to do it the most straightforward way, or you want to check yourself. But I would also think it's fantastic if you can just reason through what happened here. Why did our accounts receivable go up? Well, we recorded the revenues and that's reflected on our income statement that increased our net income, but our customer hasn't paid us yet. And so we don't yet have that cash. An increase to a current asset means our cash is lower than we would think it might be. And so we need to subtract that out. And that's what that guidance page would tell you. On the other hand, an increase in a current liability, such as accounts payable, where does that come from? It means we recorded an expense, but we didn't yet pay the bill. And so we held on to our cash, and our cash would be higher than net income would lead us to believe. And so an increase in a current liability is shown as an addition to our cash. We held on to our cash longer. So now to finish this exercise, we simply need to add down that column, pay attention to the negatives and positives. That's why they're very important, so that we can just sum that column. And I got $502,960. As I pointed out in classes, we did a few different examples of the operating activity section of the cash flow statement. Net income could be a net loss. That number could be negative. Many of these adjustments could also be negative. And so if the starting number could be negative and many of the adjustments could also be negative, this net cash flows from operating activities could be negative. It's not what you want to happen as a business owner, but it certainly could happen at times. And so I'm just pointing that out. I don't want you to think that that's incorrect or that it can't be a negative, because it certainly could. It's not ideal for a business, but it can happen. So once we finish the operating activity section using the indirect method, we move on to the investing and financing sections. So the investing and financing sections, we use a direct approach. In other words, we say, here's where the money came from, here's where the cash came in, here's where the cash went out. We do not use the indirect method for investing and financing. They are done in a more direct approach. So this next exercise deals with land transactions. IZ Corporation purchased land for $425,000. Later in the year, the company sold a different piece of land with a book value of $225,000, and they sold it for $270,000. So land makes this a little easier because we don't have to deal with the depreciation piece. The fact that we sold this land for more than we had originally paid for it means that on our income statement, we would have reported a gain on the sale of that land. As we just discussed in the previous exercise, this would be shown, this gain on the sale of land would show up in the operating activity section. It would have increased our net income, and so we need to subtract that back out. The gain is $270,000 minus $225,000. That gain is $45,000. And that again would have increased our income on the income statement, but it is not related to operating activities, and so we would need to subtract that out. And it does tell us to use the negatives here. Certainly on the actual cash flow statement, we would show that as a negative, as we just saw in the previous exercise. In the investing section, though, as we buy and sell land, we would show the actual cash received and cash paid. That's the direct approach. So cash received from sale of land would be shown in the investing section. Buying and selling of plant assets, fixed assets, and financial assets, all of those are things that you might see in the investing activity section. We sold it for $270,000, and so we would show it as a cash inflow of $270,000. When we bought more land, again, it would be an investing activity. This would be a cash outflow, and it tells us that we paid $425,000 for that. Moving on then. Dealing in our own common stock on the cash flow statement would be considered a financing activity. So buying and selling our own stock, paying dividends, all of those are our financing activities. Other financing activities include borrowing and paying back the amount that we borrowed. Payment of interest on borrowing is considered an operating activity that's already included on the income statement. Jones Industries received $800,000 from issuing shares of its common stock and $650,000 from issuing bonds. Again, both of those are financing transactions. During the year, Jones Industries also paid dividends of $110,000. How are the effects of these transactions reported on the statement of cash flows? So we know that they're all going to show up in the financing section, buying our own stock, selling our own stock, issuing bonds, repaying the face value of those bonds, and paying dividends. All of those are financing activities. So when we issued the common stock, we received cash for that. So we're going to show that as a positive. When we issued bonds, we were borrowing money. Again, we received cash for that. And when we paid dividends, that was a cash outflow. We used cash to pay back, to pay those dividends. And so those are the most common transactions that you're going to see on the cash flow statement in the financing activities section. We could also see buying back our own stock as treasury stock, which would be a cash outflow shown as a negative. Paying back what we borrowed would be a cash outflow shown as a negative. Okay. And so that is everything from chapter 13. We talked about the operating, investing, and financing sections of the cash flow statement. And we're ready to move on to our final chapter. So the final chapter, the one that we just covered last week, was financial statement analysis. We looked at horizontal analysis, vertical analysis, common size statements, and then some ratio analysis, pulling together many of the ratios that we had covered individually in earlier chapters. The comparative accounts payable and long-term debt balances for a company follows. We're asked to do the horizontal analysis of just these two accounts. And so we showed that horizontal analysis is just looking from one year to the next. We include two additional numbers, the absolute change, which is the dollar amount of change, and then the relative change, which is the percent change. So for our accounts payable, the amount of change, the dollar amount, we take the current year, subtract the previous year. As long as you do it in that order, if you have a positive value, you know that that's an increase. So current year minus previous year, a positive value is an increase. And then to find the percent, we take that dollar amount of increase and divide by the older year. So the previous year's number was $102,000. 14,280 divided by 102,000 is 14%. And for the long-term debt then, we take the current year, we subtract the previous year, and that of course would be $9,600. And because the current year is higher, that would be an increase. Find the percent increase, we divide by the older year. 9,600 divided by 120,000 is 8%. Okay. We also talked about vertical analysis, and we know for vertical analysis, we set the largest number at 100%, and then we express each of the other lines on the financial statement as a percent of that total. So on the income statement, we set sales at 100%. On the balance sheet, we set total assets at 100%, which of course is also the same number as total liabilities plus equity. So again, these are brief exercises, so they just get the point across. They don't make you go through a whole lot of additional calculations. The assumption is if you can do it for one line, you can do it for 7 lines. So To do a vertical analysis up and down, vertical analysis of the income statement, we set the sales at 100%, and then we express the lines that come after that as a percent of that total sales. So 900,000 out of 1.5 million is 60%, 0.6 or 60%. For the gross profit, we can just subtract. If cost of goods sold is 60%, that leaves 40% as gross profit. But you would get the same answer if you did the math. 600,000 divided by 1.5 million is 40%. Okay. And so that's vertical analysis. The idea of a common size financial statement means that we would basically hide this column that has the dollar amounts in it, and we would show just the percentages. Once we have those percentages for the year, we can compare those percentages to another company that might be a very different size from our company, or we can compare them to our company from a previous year. For current position analysis, we talked about working capital, which is simply the difference between our current assets and current liabilities. So it's expressed in dollars, but we can also look at current ratio, which is those same two categories, but it's current assets divided by current liabilities. And the quick ratio, the denominator is still current liabilities, but the numerator is only the financial assets. So we can assume, because this is all that's given to us, we can assume that we have all of the information we need here, that these four accounts make up our current assets, and this one account is our current liability. So to calculate the current ratio, we're going to add together the four current assets. And I got $729,600 in current assets. We divide that by the current liabilities, accounts payable, 228,000. And I got a current ratio of 3.2. So added the total current assets divided by the current liabilities, I got a ratio of 3.2. As we discussed in class many times this semester, we can't just look at that number in a vacuum and know, is that okay? Is that good? Is it bad? I don't know. We need to compare it to something. So we do have a rule of thumb for current ratio of 1.6. As long as we're at 1.6 or higher, we're probably fine. So it looks like this company is fine. We could also, of course, compare it to what was it last year. We could compare it to our competition. For the quick ratio then, it's a very similar calculation, but as I said, we only use the financial assets, the assets that are more readily available to use to pay our bills. And so we want to add together just those three items that I have highlighted. We don't want to include the inventory. And so that brings our quick assets down to 602,600. We still divide by that same current liabilities, and we need to round to one decimal place. So I got 2.64, which is 2.6 rounded off. We do also have a rule of thumb for quick ratio. We're looking for a ratio of at least 1.0. And so again, it looks like this company is fine, that they have plenty of current assets available with which they can pay their current liabilities. And then have quite a significant cushion in case some unexpected need arises for that cash. Moving on to our accounts receivable analysis. So we first covered this back in the receivables chapter, which was chapter 8. And I'm going to, just like I did in class, in that chapter and in chapter 14, I'm going to give you an easier approach to calculating accounts receivable turnover. Would also remind you that in the chapter 14 folder in Brightspace, I have a couple snips from the book that show all of the formulas that you might need to do any of this type of analysis, inventory analysis, receivables analysis, payables analysis, all of the market strength and profitability and solvency ratios that we talked about in class last week. So all of the formulas are included right there in the reference materials folder for you. So for our accounts receivable turnover, the formula is sales divided by average accounts receivable. Now they've done us a favor by giving us that average accounts receivable already calculated, but remember, to calculate that, we would just take the beginning and ending balance and add them together, then divide by 2. So receivables turnover, sales, $5,250,000 divided by average accounts receivable of $350,000. And I got a turnover of 15 or 15 times. It says to round final answers to 1 decimal place. Really round there. So on average, we're collecting our receivables 15 times a year. That's more than once a month. So our customers, we already know, are taking less than a month on average, taking less than a month to pay us. Now the book gives you a more complicated calculation for days sales and receivables. I'm not covering that because once we have receivables turnover, it's very simple to just divide that into 365. 365 divided by 15 gives us a, rounding to 1 decimal place, 24.3 days. On average, it's taking us 24.3 days to collect our receivables. As we discussed in class, again, we'd want to compare that to, well, how long are we telling our customers that they have to pay? If we're telling them 30 days, they're doing fine. If we're telling them 15 days, they're paying, on average, they're paying almost 9.3 days late. And so, that's not a good thing. That would tell us that we might have a liquidity issue if our customers are taking too long to pay. It might mean that we're at risk of maybe having a higher uncollectible accounts than what we had planned for if our customers are slow paying. At minimum, it's slowing down our cash, our liquidity. And so it's definitely something to be keeping in mind. Next exercise is inventory analysis. Again, we talked about this in chapter 6. Originally, we recovered it, reviewed it last week. And again, days sales and inventory, I gave you a much simpler calculation than what the book asks us to use. So the formula for inventory turnover is cost of goods sold from the income statement divided by average inventory. Again, they've made it easy for us, giving us the average inventory, but you can calculate that yourself by taking the beginning of the year, ending of the year balance, add those together, divide by 2. So we take the cost of goods sold, divide by that average inventory, and we got an inventory of 12 times. 12 times a year means once a month, right? And so as we turn that into number of days, we know it's going to be about 30-ish days, about once a month. The easier calculation I provided to you was 365 divided by that inventory turnover, and oops, in that cell. And so 365 divided by 12 is 30.4 as when we round to 1 decimal place. So we're sitting on our inventory for about 30 days. Is that good or bad? Well, it depends on what kind of industry you're in. If you're a grocery store, that's really slow. Their average turnover is going to be more in the 10 to 15 day range. And if you are a department store like Kohl's or JCPenney, that's actually super quick. They normally turn over their inventory seasonally, 4 or so times a year. So I need something to use as a comparison to know how we're doing. But the implication for our liquidity is clear. The longer we're sitting on our inventory, the longer our financing period, our cash cap. We had to pay our suppliers for this inventory, and then we have it sitting around waiting to be sold. And the longer it sits around, the longer it's going to take for us to get our money back from our customers and be able to put those those funds back into the running of the business to pay our bills, to buy more inventory, and so on. And so I can't look at these numbers and know if they're good or bad because we don't even know what this company does. It just says a company. So we have to have something to use as a comparison. Our next exercise then is long-term solvency analysis. And we have first our ratio of fixed assets to long-term liabilities. You know, the names of these formulas tell you exactly what you need to do. The fixed assets divided by long-term liabilities. So fixed assets of 1,176,000 divided by the long-term liabilities of 280,000 gives me a ratio of 4.2. As I just said, I can't look at that number and tell you is that good or bad. It depends. It depends on what type of company this is. At least they give us the name of the company here, but that doesn't tell me what they do. So I need to have something to compare. Either how did we do last year, or what was our goal for this year, or what does our industry do on average? And then for the second one, ratio of liabilities. So we're looking at all of our liabilities, $960,000 divided by the stockholders' equity, which we're told is $320,000. And that ratio is 3. That is a measure of our leverage, of how much debt we have in our capital structure. As I described it last week in class, they have $3 in debt for every $1 in equity. For some investors, that's going to be very attractive. This is a pretty highly leveraged company. And for other for other investors, they might say, you know, that's a little bit too risky for me. Debt is definitely more risky than equity because debt has to be repaid with interest on schedule. And moving ahead then to our final exercise. This is what I referred to in class as the market strength ratios. So this is, these measures are based on how our stock is performing compared to how the company is doing. And so the first calculation is earnings per share on common stock. If the company has preferred stock, we need to subtract those preferred dividends from the net income to find out how much earnings there were for the common stockholders. So 650,000 in total income minus the preferred dividends of 45,000 means that there was $605,000 worth of earnings for the common stockholders. Then we divide by the weighted average number of common shares outstanding, which is given as 110,000, and we get an earnings per share of $5.50. Is that good or bad? I don't know. How much is the stock worth? If the stock costs $1,000 and they're only making $5 for us, that's not so good. If the stock costs $10 and they made $5, that's pretty darn good. So that's where the second calculation here comes in, the price to earnings or PE ratio, where we take the market price of, in this case, $44, and we divide by the earnings per share that we just calculated in part A. So $44 divided by 5.5 gives us a PE ratio of 8. Then again, last week in class, I described the difference between a growth stock versus a value stock. A growth stock has pretty low earnings compared to the price of the stock because the idea is this company is growing, it's expanding, and you're buying in for future earnings, buying because of the potential of that company to make money in the future, compared to a value stock that has relatively high earnings. So a value stock has a very low PE ratio. This company would be considered a value stock. A growth stock is one that has a pretty high, usually greater than 15 PE ratio is considered a growth stock. And so a value stock, again, pretty high earnings compared to the price of that stock. So we don't expect there to be a whole lot of growth for this company, but it's pretty steadily producing right now. Oh, Oh, because I'm not at 100% because I skipped that one exercise. I was alarmed there for a moment because my score was only 93.3. For those of you who are maybe working on this practice set and you're used to keeping an eye on that score, keep in mind it's not going to get to 100% unless you repeat that exercise number 1, and that's fine. These are not graded. They don't show up in your grade book at all. So that's the end of the practice set. Any questions, anything else you want to talk about today? I'm going to go ahead and pause the recording.